Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. The UK smaller companies sector has a history of strong performance following economic downturns. 15 years ago, on September the 15th, 2008, Lehman Brothers collapsed. The global financial crisis was then about to get much worse. But if you had invested in the average UK smaller companies investment company at the end of September 2008, your investment would be up 39% 3 years later and up 134% 5 years later. And if you were a long-term investor and you held on today, it would be up 316%. With 26 investment companies to choose from, trading at an average discount of 12%, what is the outlook for UK smaller companies investment trusts? Today, I'm delighted to be joined by 3 UK smaller companies investment company managers. George Ensor, Portfolio Manager of River and Mercantile UK Microcap. Amanda Yeaman, Co-Manager of Aberdeen UK Smaller Companies Growth. And Ken Wotton, Portfolio Manager of Strategic Equity Capital. Right, on to the questions. Now, clearly the UK has been unloved. What are the challenges of investing in these very difficult conditions? And I'd like to ask that to Amanda.
Yeah, hi Annabel, thank you. Yeah, it certainly has been unloved. And I think if we could characterise the last 18 months, it has been a market which has been driven by the macro. So we've been in a top-down environment, and that's challenging if you're a stock picker because companies have not really shone based on fundamentals, and that's been difficult for a stock picker.
Yes, I can understand it's very difficult. George, how are you finding it?
Yeah, so I guess it's a similar kind of message, but we've experienced 24 months of consecutive outflows from smaller companies funds, open-ended smaller companies funds. Whilst we run closed-ended investment trusts, we don't need to worry about meeting redemptions. Clearly, the backdrop in the market is of people managing the liquidity profile of their funds rather than necessarily trying to maximize on the returns potential. So, there's an aversion to illiquidity. Our strategy is a micro-cap investment trust. We're trying to invest right down at the bottom of the small cap universe, and people have been very anti sub 100 million market cap companies for a couple of years now. So I think the biggest challenge has been that liquidity challenge.
Absolutely. And Ken, are you finding it similar conditions?
It's clearly challenging, mainly because of the uncertainty that companies are seeing. So it's not just the stock market environment, but the economic environment has been challenging and visibility has been more difficult. So the companies themselves have really got to sort of consider the outlook for their businesses and trying to forecast that's quite difficult. So, and then from a fund manager's perspective, trying to find the businesses that have adequately forecast what's going to happen is challenging. But if you can get that right, the sentiment and top-down driven market, as it was touched on a minute ago, that has created a whole host of opportunities. So the glass half full way of interpreting the current environment is that great companies have been derated alongside poorer quality ones, and that's a great investment opportunity for us. And if you look over the next sort of few years, I think we'll look back and this would have been a great time to invest.
Right, so moving on to the opportunities, and let's hope it is a great time to invest. Where are you finding opportunities, George?
So I think if you look at the UK market, UK small cap market as well, valuation dispersions are very high. So if you take each sector and you look at the spread between the most expensive and the cheapest stock in that sector, the dispersions, they're near record levels. So that means it is a fantastic environment to be active, to be a stock picker, to run a high conviction portfolio. Those should normalize over time, and when they do, that should deliver excellent performance. So I think where we've been finding opportunities actually sounds a little bit boring, but we've been adding back to some of our long-term winners at extremely depressed prices. Some of our positions have derated by 50-60%, and we've been rebuilding our stakes in them, having taken gains. And then, additional new positions. Tech has been an area we've put capital into recently. It's experienced a substantial derating. So yeah, the valuation dispersion point would be the focus.
Great. And Ken, where are you finding opportunities?
I think I'd sort of echo some of the comments that George made. So, because of the derating and because of the somewhat indiscriminate derating between sort of higher quality and low quality companies that we've seen over the last sort of 18, 24 months, we have been adding where we've got high conviction in the long-term fundamentals of existing portfolio companies. That's where we've found some of the best opportunities. And because the trust has the ability to take a different view to an open-ended fund on liquidity, and because the strategy that we employ with strategic equity capitalists take larger stakes in some of the underlying investee companies, this has been a pretty good environment to find liquidity on the way in because other people have been forced sellers. So we've been able to build quite meaningful equity stakes in some of our companies, and where we've got high conviction about the long term. So that's not particularly sector specific, though business services, some bits of healthcare services, and especially some bits of financials we think are really quite attractive at the moment.
It's interesting that you're able to build bigger positions, actually. I think that's really interesting, a benefit of the investment company structure. And Amanda, where are you finding opportunities?
Yeah, I think that's right. I mean, I think I can also echo the valuation point, and there's no doubt about it that some of our quality growth companies are trading on, value multiples at the moment. So that is one opportunity. I'd also pull out that we have our stock screening tool called the Matrix, which has been really core to our process. And what that does is that helps us identify stocks with quality growth and momentum characteristics. Now, while those aspects are really rigid, we stick to that process and we look for those sorts of companies. The type of company that fits that profile does change throughout the cycle. So we've had a really useful screening tool, which has no emotional attachments, which has been flagging some good new ideas to us, which fit our investment process. And we do have, a long list of stocks on our watch list at the moment. So it's been really useful for flagging opportunities, making sure we're staying on top of our universe where that changes. So we are seeing a lot of opportunity in the UK market at the moment.
Excellent. Now, it does feel like we're near the top for interest rates, I have to say, thank goodness. And I'm wondering, what are your thoughts on this? And could this make a difference for smaller companies? Ken, I'm going to kick off with you.
Sure, thank you. So first thing I'd say is that we try to be relatively agnostic in our investment approach to big macro factors like interest rates. Now, that's not to say that we aren't affected by them, but we're trying to always build portfolios of companies that can thrive and can deliver value, even regardless of the kind of external environment. So whether the economy is growing and what rates are doing, or other big macro sort of factors that affect sentiment and other parts of the economy. Having said that, clearly the major change in the rates environment over having been very benign for 15 years has changed the dynamic in terms of how particularly longer duration and kind of higher growth stocks have been valued. But because we're very focused on valuation, there's a lot of the companies that have been derated really materially were valuations we just wouldn't have invested in them before. So because they didn't meet our criteria. So actually, sort of slightly counterintuitively, the changing rate environment and that derating has put a lot of high quality growth companies back into our sort of area where we actually might back them. And so there's lots of businesses we've tracked for years where they've just been too expensive, and now they're not. So that's been good from our point.
Really great that it's actually great. Well, I mean, I can't say it's really great because it's been very, very tough, but it is good that you're seeing those opportunities for those companies that you've wanted to, buy for a long time. That's really encouraging. Amanda, how about you? What's your view on the way forward for interest rates and how that could make a difference for smaller companies?
Yeah, similarly to Ken, we don't take macro bets. We buy high quality companies that can perform in all environments. And this is what's happened. We've had some great companies within the trust and they have performed really, really well. But against a backdrop which is dominated by inflation, a style has been out of favour. And all the good performance and resilient earnings that our companies have delivered really haven't been rewarded in terms of share price. Now, I think we can all agree that after last week, we've probably reached peak interest rates, and the direction of travel is to the downside from here. And that's really what we've needed for our style. For quality growth, we've really needed to break that inflation spell. And I think we can all agree that the future certainly looks better for the past, for the path of interest rates. And that's great for smaller companies. It's great for quality growth. And it's also great for sentiment. It improves consumer confidence. And that takes us away from all of the cost of living crisis that has been so dominant for so long.
Absolutely. And George, what's your view on rates and the impact this could have?
Yeah, so we think there's quite a sensible 4-point checklist for getting more constructive on equities in general in a bear market. The first is actually peak interest rate and inflation expectations rather than actually the point where they peak. So I think you can go back to the summer and you can see that the market was expecting the bank rate to get up to 6.25%, 6.5%, and inflation on a 3-year view to be 6.2%. So we're well past that now. We've clearly at 5.25% on the bank rate, and it looks like it might be stable there for some time. The second is trough valuations. The UK market, UK small cap market, is very cheap. So I think we can put a tick next to the first two. The third is very negative positioning and sentiment, and I think we would all agree that the positioning and sentiment towards UK small caps is extremely negative. So we're pretty sure we've got that one as well. The fourth is the rate of economic deterioration. So you want the rate of the economy slowing to start to improve. It doesn't need to flip positive, but it can't be getting worse more quickly if that makes sense. And I think we definitely had that from November through to June or July this year. We were outperforming on GDP. The UK was one of the most upgraded economies from a GDP perspective. I think part of that was expectations were extremely negative around October, November last year. More recently, PMIs have rolled. So perhaps waiting for those to trough would put a proper tick next to the last of those points. But it certainly feels like those set up a great period of outperformance for smaller companies.
Yeah, from what you say, it sounds like we are getting the goodness. Now, on another topic, we all know there's an election next year. Would Labour winning make any difference to our UK smaller companies? Amanda?
Well, I think we'd get, it doesn't matter really who gets in, but I think we'd get a period of much crave for stability after the roller coaster we've had for the past 5 years. And it's one thing that's really clear to us from our meetings with management is that you can't plan where there's uncertainty. And if we get a Labour government in, then at least we know that's where we are for the next 5 years. I've not really dug into the manifesto, but I would suspect that they would be potentially more interventionist and more activist than a Conservative government. But companies need to know where they stand. And if we get a change in government, we'd at least have more of an idea of policy from there, because from there, planning, is made a lot easier.
Yeah, so stability is very important. George, what's your view on this?
Yeah, I think the UK has suffered from a lack of investment, and that's actually caught up. In the last 6 or 9 months, there has been some stability. Appreciate we've got an election on the horizon, but the rate of investment into the UK has significantly picked up. So you can see the impact that a stable government and perhaps a less media-friendly government has. In terms of being very high profile about going out with lots of ideas and then perhaps not following through on any of them. And then in terms of what the impact could be, we want stability, but statistically, historically, there's been very little difference between equity performance in Conservative and Labour governments. And actually, Labour governments are marginally ahead of Conservative governments in terms of equity performance. So there will be a period of uncertainty into the run-up where lots of the manifesto commitments come out. And that might drive sector performance. But I think at the top level, it's not going to be a material delta, I don't think.
Not too much change then. Ken, what's your view?
Again, and just in similar to what I said before about macroeconomic sort of factors and trying to take a position which is agnostic to what's going on. I think we similarly take that view about political backdrop, but that doesn't mean that it doesn't cause periods of uncertainty and that creates volatility. But we're really focused on the individual companies, and so if there are specific policies that may impact or benefit individual companies, we will clearly take those into account when we evaluate the businesses. But really, we're trying to find a very high conviction, pretty concentrated portfolio of companies that can deliver within the environment we find ourselves in. And I don't really expect dramatic changes as a result of a switch to a Labour government, if that's what happens. I think both parties have certainly sort of become, at least they're making the noises of becoming closer to the centre than they perhaps have been over the last few years. And if that's the case in practice, then I think that's a good thing for stability.
Absolutely. And just my final question there, I'm wondering what's your view on the discount on your company? Can it represent a long-term buying opportunity, and why? And I'd like to ask that question to George.
Yeah, so thank you. So we have a strategy of returning excess capital to shareholders. So over the last 6 years, 5 or 6 years, we've returned 77 million of capital to shareholders, more than the capital we raised across our IPO and subsequent placing. And that is also more than our current NAV as well, which is about 65 million. So we have a track record of returning capital. We do that at NAV. And so, you know, given that, I think a discount of 18%, which is where we currently trade, is a fantastic opportunity to buy into an investment trust that has, you know, long-term, solid, impressive track record.
Yeah, that is a serious discount. And obviously we have talked about our hope that we're actually reaching an inflection point for smaller companies. Ken, what do you think about your discount and the opportunities for long-term investors?
Well, we took on the management of the trust, having won it in a competitive tender process just over 3 years ago, and at the time the discount was significantly wider than it is today. I think it peaked at about 27%, and it's currently about 9%. So it's come in materially as we've hopefully delivered on our sort of promises in terms of performance, and where we've been more active in terms of trying to get out and tell the story and attract marginal new shareholders to the register. But the trust, nevertheless, you know, we think there's a really exciting opportunity in terms of the potential for NAV growth of the trust over the next few years, because of the quality of the portfolio companies we've got, because of the discounted valuations that they currently trade at, and you know, we've talked about the opportunity in the UK small cap sector overall. If you can get that NAV growth, but you also buy it at a discount, then it clearly is an enhancement to the potential returns you can get. And we have an active buyback policy in place for the trust. Also, Gresham House, as manager, has been actively buying shares to demonstrate alignment with shareholders. So Gresham House and its associates currently owns more than 10% of the trust as well. So hopefully we're all pointing in the right direction. And whilst the primary focus we have is delivering NAV growth, and we're also trying to bring the discount in as well. And we're targeting to buy back shares if the discount is wider than 5%, which it currently is.
Right. So, well, let's hope we've got rising asset values, narrowing discounts, double whammy impact on performance. Amanda.
Similar story. So, I mean, discounts across the sector have been frustratingly wide. The board has been alive to that. We've got an active buyback ongoing since the start of 22. We've bought back 11% of the issued share capital, and that's been effective. You know, it's stabilizing the discount around that level. But what I think we need to narrow that discount further, it's flows. And you know, for all the discussions we've had, the opportunity in the UK, we really need flows to try and turn sentiment and to close that discount going forward. But I agree with Ken. You can have, in your words, Annabel, a double whammy for investors at this point, where if we can improve the NAV performance and close the discount, then that is a very, very attractive entry point for new shareholders.
Well, let's hope we have increasing confidence. Those flows come, perhaps some overseas investors investing in the UK, and performance picks up for UK smaller companies. I'd like to thank our managers very much for joining us today. It's been great to hear their views on prospects for UK smaller companies. I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. Thanks so much for watching.